Hey everyone, welcome back to the channel where we break down stocks like we're chatting over coffee about where your money could actually grow. Today, we're diving deep into Plug Power, ticker Plug, a name that's been swinging hard in the hydrogen space and just posted some fresh Q1 numbers that have traders buzzing. Plug Power sits right at the intersection of clean energy demand and fuel cell tech, delivering end-to-end hydrogen solutions mainly for logistics, material handling, and now pushing into on-road and stationary power. With energy needs exploding worldwide, this isn't just another green story. It's about whether Plug can turn its scale into real profits after years of heavy investment. Founded back in 1997 and headquartered in Latham, New York, Plug Power has grown to about 3,200 employees under CEO Jose Luis Crespo. The company focuses on hydrogen fuel cells for forklifts and beyond, with big partners like Amazon, Walmart, and Phillips 66 already in the mix. It's not a startup anymore. It's a player trying to prove the hydrogen economy can actually scale profitably while competitors circle. Looking at the latest full-year breakdown, Plug pulled in roughly $710 million in revenue, with the United States accounting for about $536 million and non-U.S. markets adding $174 million. Product-wise, sales of electrolyzers hit $188 million, fuel delivered to customers came in at $133 million, power purchase agreements added $108 million, and fuel cell system sales plus services filled out the rest. That mix shows they're not just selling hardware, they're building recurring revenue through fuel and infrastructure deals, which is key for long-term stability. On the earnings front, Q1 2026 delivered revenue of $163.5 million, up 22% year-over-year and beating estimates. The loss narrowed to 8 cents per share versus the 9-cent consensus and a much wider 21-cent loss last year. Gross margins are improving thanks to cost cuts and stronger electrolyzer activity, and management is pointing toward 2026 profitability targets as hydrogen economics get better. It's still not profitable overall, but the trend line is bending in the right direction after massive losses in prior years. From the earnings call, leadership highlighted how cost reductions, rising electrolyzer demand, and better fuel economics are moving the needle toward those 2026 goals. They emphasized operational streamlining and strategic projects like the new UK win that's keeping momentum alive. The tone was cautiously optimistic, acknowledging challenges but stressing execution on hydrogen infrastructure as the path to positive cash flow. The balance sheet tells a story of heavy spending, total assets around $3.6 billion, with current assets near $1.5 billion, but long-term debt and liabilities keep the leverage elevated at a debt-to-equity ratio over 1.3. Cash flow remains negative, with operating cash burn and capital expenditures for expansion still weighing on free cash flow. Key ratios like gross margin at negative 25% and net margin near negative 227% show the scale-up phase is expensive, though the improving current ratio above 2 suggests liquidity isn't an immediate crisis. At a share price near 3.78 and a market cap of about $4.3 billion, Plug trades at a price-to-sales multiple around 5.9 times. With negative earnings, traditional PE doesn't apply, but forward-looking investors are betting on revenue growth in a high-demand hydrogen market. Compared to the broader industrial sector, the valuation feels rich if execution slips, but reasonable if margins keep expanding toward profitability. Strengths include established scale with nearly $191 million in Q4 revenue and a growing partner base that validates the tech. Weaknesses center on persistent losses and negative margins that could pressure the stock if growth slows. Opportunities lie in surging global energy demand and new projects like the UK win that could accelerate adoption. Threats include intense competition in the hydrogen space and any delays in reaching positive cash flow that might force dilution. Over the past year, Plug shares are up about 7%, with a strong 20% gain in the last 6 months, though the 3-month period shows a slight dip and the 5-year return remains deeply negative at 95%. The stock has flashed some bullish patterns recently, including a post-earnings surge, but it remains volatile within the electrical equipment industry that's been mixed overall. MarketSnap brings everything long-term investors use daily into one clean, fast platform. Explore stock financials, SWOT analysis, valuation ratios, 5-year analyst estimates, and our intrinsic value calculator, built with real fundamentals, not hype. All in a layout that's simple to read and ridiculously fast to navigate. And when you want to talk investing, join Nexus, our community where investors share valuations, posts, and stock discussions, all connected directly to the data. Use our stock's intrinsic value calculator to run and save real valuations with no spreadsheets. Share your analysis and valuations with others in the Nexus community. Get daily market summaries in video, audio, and article formats. Track the market with our earnings, dividend, and economics calendar. Our homepage gives you a real-time market overview with interactive heat maps, top market movers, and major index performance at a glance. Track daily performances, discover the most active stocks, and analyze performance across different timeframes, from weekly to yearly trends, and see which industries are leading or lagging. It's free to create an account, with optional access to premium forward-looking data. Try it now at MarketSnap.com and invest with clarity, not noise. That's a wrap for today's stock market summary from MarketSnap. Thanks for tuning in, and make sure to stick with us for daily updates and deep dive SWOT analyses to keep your investment strategy sharp. Whether you're navigating short-term turbulence or building wealth for the long haul, we've got the insights to help. See you tomorrow.